Hello, everyone. David Moore and Thomas Moore, the 1031 Bros. We're going to start this conversation off talking about retirement accounts. How'd that ever happen?
Yep, we've got a client that has an interesting question. Hopefully, it's easy to follow. You want to
Yeah, so,
put it
so,
forward?
so I think this really, the message isn't easy to follow, like we just discussed, but I think the idea is. So really what happened, we had a client call up and they're asking about their ability to pay off a property that their retirement account owns with proceeds from the sale of their primary residence. And they went into a bunch of details on the sale of their residence and why they weren't going to have tax exposure. And so that's another conversation. You could take a look at one of our other videos on Section 121, the universal exclusion. It'll talk about that. And also, just for future context, it is August 20th of 2025, and we are hearing some chatter about elimination of any tax on the sale of a primary residence, which that would make our lives pretty interesting, I think, for a period of time. Don't you think, Tom?
Yeah, maybe they're trying to make up for some time lost here. It's been at our current 250 and $500,000 exemptions for what now? 1997, I think it was.
97. Yeah, they're right on top of this.
Yeah, yeah. Long overdue for them to do something.
Yeah, but a property costs the same as it did in
Exactly.
1997, right?
Exactly.
Yeah, things have changed a little bit. So if we look at that, really the question was whether they can take money, personal money, and pay off a property that's owned by the retirement account. And if you look at things on the surface, you'd have to say, well, how we approach whether you can or can't do something with a retirement account. Typically, we look at those two factors, right?
Yeah, and the primary thing is, are you personally benefiting the IRA plan, or vice versa? Is IRA plan benefiting you? Is there's that beneficial relationship? And certainly, if you're taking personal funds, whether it be from a sale of your personal residence or any other source of funds, if you're using that to pay off a debt of the IRA or 401k plan, any qualified plan, you're clearly benefiting the plan. So it would create a prohibited transaction.
So when we look at those retirement accounts, if you watch our videos regularly, you're going to hear us talk about. You look at two issues: what's a person want to buy, and an IRA can buy anything other than collectibles, life insurance contracts, or stock in a sub-S corp. In this situation, I believe the guy's talking about a 401k plan. So the only thing they cannot buy with a 401k plan is collectibles. Now, keep in mind, that's the legal restriction, but the restriction that he's probably facing is what the plan document restricts him to, wouldn't you say? If we're looking at an IRA context, typically your restriction is rarely going to be by law. It's going to be by that trust company, what they're going to allow you to do. But if you look at, so what do they want to buy and who are they transacting between or for the benefit of, and that's where Tom's looking at this payoff as a benefit to a disqualified party, which would constitute a prohibited transaction, which with a 401k plan would mean just the funds involved with indiscretion would be treated as distribution. But if it's an IRA, all funds in the account would be treated as distributed as of the first day in the year in which the indiscretion occurred. So you don't want to do that.
Yeah. So if you had an IRA LLC or anything of the sort that has multiple properties and use this money to pay off one property loan, then yeah, you're exactly right. The entire IRA, meaning all the properties, all the assets within it, it's all being treated as though it's been distributed to you. So you're facing taxes on distribution and possible penalties.
So now that we've told them for the last couple of minutes that you can't do this because it's a prohibited transaction, is there a way that it could be done? And have we done things similar through the years using retirement accounts to take care of different problems for people?
Yeah, there's an avenue that they could take. It might not give them what they ultimately want down the road, but if they were to do, let's say this 401k plan owns a piece of property, if they were to say structure a new LLC, a partnership that is purchased by both the 401k plan and by themselves individually. And for the 401k plan shares in the new entity, they are contributing the property, and maybe maybe the plan also contributes some cash. but it can contribute the property for its membership interest. The individual can contribute cash for his or her the interest in the new LLC. And now you've got a new entity that has cash and owns property that has debt on it. So then that new entity could take the cash, pay off the debt. Now you've got a new entity that has whether it's a debt-free property or property that's significantly paid down. Bottom line is the plan does not own that property in full anymore, and there's no way for the plan nor the individual to buy that property from one another in the future. So it's really a matter of it's going to sit in that entity until maybe a distribution takes place in the future.
So the last recession, we would have people call up saying, hey, I'm going to lose a property. Can I use Dad's IRA or whomever, my IRA to go pay the property off? And we would use that structure, create the entity. The individual would contribute the property. The plan would make the investment. Now the entity owns the property and has the cash to pay it off. And so we're using that same structure in this case, just with the flip-flop on it.
Yeah, and it's important to realize too. A lot of people were thinking, well, these, the plan and the individual are disqualified parties, right? So how can we do that? And the reason that they can do that is what these disqualified parties are investing into is a new company that is not owned by either one of the individual or by the plan at that point. So as long as the disqualified parties are investing alongside one another into a new venture, that's totally fine. What they cannot do is they cannot buy from one another. So transactions alongside one another, fine. Transactions between one another are not fine.
That makes sense to everybody, right? So I think this conversation is one that yesterday in our sales marketing meeting, we were talking about the impacts of AI and different things. And I just think that this is just a prime example of what do you ask? I mean, you don't know what you don't know. So really, you're going to get sort of what you're looking for, and it's going to give you an answer based upon what it knows. And is that information good or bad? But I think this is just one of those great examples of, really understanding what you cannot do. And there's no substitute for experience in these things. And it was sort of funny because those of you that are regulars on the channel know that Tom and I spent a lot of time in the ocean growing up, and with our younger brother Greg too, and Mom would be worried. Well, where have you guys been? I'm going to call the Coast Guard. You guys are way late. And Mom, relax. No call's a good call. But somebody posted something recently, and it showed this, this real extreme ocean conditions, and somebody going out sailing, and people's response, "Oh, that's crazy. They shouldn't do that." Da 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 da. And I would say that that experience is what you're going to learn. Either you're going to learn, you're going to be taught, right? And so you just to understand, and now you and I have been doing, if we're talking 1031 context, we've been using them since 90. We've professionally done them since 91. We've done a few of them. If we look at the retirement stuff, it's been the mid-2000s roughly since we got in that business. But I think that it's interesting because when you've gone through those things, you have the stories, you've got the experiences, whether it's good or bad. But if you don't have that, you're not going to learn it reading it. And you made a comment about transactions and going along with. And I think that's a really critical thing for people to understand. You can transact along with a disqualified party. You just can't transact between or for the benefit of a disqualified party. And so, once again, in this situation, we've used it on the opposite side, saving personal properties. In this situation, he wants to take personal proceeds, pay that property off that's owned by the retirement account. As Tom explained, you can do that. The downside, as you mentioned, is that he may have a situation that he didn't really want to have, is now that he's got a jointly owned property, personal and plan. And so typically, how would we get the property back? Let's say if we look at retirement accounts, one of the big objections Wall Street has about taking retirement accounts to go buy real estate is what happens. You get to the point where you got to take RMDs. There's no cash to get to take that, you're going to have a penalty. But what do we do in that situation? One might be a solution. Let's say that he either wants to end up owning the property personally, or he wants to have it owned. Well, he's not going to get it owned all by the plan again, but at some point, how would he
Yeah.
end up owning it personally since he can't buy it from the plan?
Yeah, and that's a good question. And the only way for them to receive the property, and they're going to have to, over the years, they've got to take distribution. So if there's no cash in the plan to take, or the cash within the plan is not enough to cover the RMD, and this is for IRAs, 401k plans, what they're going to have to do is they're going to have to take assets as their distribution. So they take an asset in kind distribution, and in this case, they can either take, what is owned by the plan is shares of this new LLC with this example. So what the individual would have to take is LLC shares as a distribution, and so their partnership interest in that new entity starts increasing each year if they're taking shares each year, and then at some point in time they would fully own that LLC themselves. The LLC shares would have been fully distributed from the plan to themselves. And sometimes that's the goal with people. If we have people that will go out and they'll buy a rental property, and with the idea that it's going to benefit their IRA over the years. But this is a property that they really like, and they want to have that property in their retirement years, and they want to have the income from that property and just have a stable monthly income. And so sometimes that's the goal of somebody that sets up, like, say, an IRA LLC, is that's what they want to have. They'll buy the asset and hold it, and then start taking distributions. And maybe they'll have it set up where they're going to take a distribution of 20% of the LLC shares over 5 years if they're in a hurry to take it on, and so they've got this partnership entity over a 5-year period, and at the end of it, they've got the asset fully owned by themselves. The LLC is now theirs in full, and it's no longer an asset of the IRA account.
So that would be the solution for somebody that finds their dream house on the beach to retire into, and they can't afford it, and they want to use their retirement account to buy it. That's what they'd end up doing. And then as far as let's say if I've taken, using your number, I've got a 20% distribution annually. If I take a 20% interest as a distribution, could I use it 20% of the time?
No. Unfortunately, and that question is brought up all the time when people start hearing about this strategy. Can I start using the thing? And the answer, unfortunately, is no. You cannot until such time as you own it in full. So if the plan or IRA account has any ownership interest in that asset, then it again creates a prohibited transaction for you to utilize the property, whether you're paying the plan to use it or not. It's they're seeing it as you're benefiting.
That comes up a lot.
Yep.
All the time.
Yeah, and again, you mentioned the questions, people coming up with questions. Maybe we'll talk about this a little bit more, but people don't always know what questions to ask when they call in, and they may just ask, well, can I do this? And yeah, you can do that. And if you're asking AI if I can do that, then that's what you're going to get. Yeah, you can do this, but you're not given all of the other
fine nuances.
You're not finding out what all that entails down the road. You don't get the full story. So, and we don't know all the answers either, but we certainly have heard a lot of the questions. We don't know all the questions to ask, but again, when we do talk to people, their call in for one question might end up being a 45-minute phone call.
Well, so let's talk about that, because once again, we were talking about AI yesterday, and this morning you and I had a conversation about a variety of different things. But if you look at what to ask or how you ask it and the response you're going to get, but when you start looking at what we deal with, I mean, really, it's tax and legal stuff, the tax law. How often is there a black and white answer on anything? Rarely, right? I mean, it's really a question whether you can or can't do something. It's how you're going to do it, and whether you can do it or not, it's whether you've taken the time to plan it out. And I think that when we look at this stuff, so if we just look at questions this morning, that was the one issue we want to talk about with retirement accounts today. When we start looking at 1031s, we're always looking at, okay, what questions should we answer in that space? And the questions that come up this morning, for example, is like, okay, what to do when a seller wants to do a 1031 exchange? How often have we, gotten involved with a transaction that maybe somebody else had structured that was unnecessary or wasn't done correctly? So, what would be your response to, what to do when a seller wants to do a 1031 exchange? I mean, where would you go with that? And just back to what you said, okay, it might lead to a 45-minute conversation. Typically, I mean, really for the audience, how long is the typical first call with somebody?
I would say an average first call would probably be around half hour anyway. But it's certainly not uncommon. It goes 45 minutes or an hour.
And then we have somebody that wants to text a question or just go back and forth email.
Yeah, and we've got consultants in here that I know I'm walking by their office all day long every day, and they're on the phone all day long every day. And so the phone calls are really crucial that people get to talk to somebody about this and not just asking questions of the computer, because again, they don't know what questions to ask. The people don't know what questions to ask usually. This one, what to do when a seller wants to do a 1031 exchange. One of the first things that we'll be asking people when somebody calls in is, do they have to do an exchange? What is it they're selling? Do they know what their basis is in their property? Do they even know what a basis is? And it's very common that people will think that their basis in the property is either the cash that they have in the property or what they bought the property for.
So that's what I was just going to ask you. So like, how often do you talk to somebody that thinks, well, gee, I'm not getting any sales proceeds. I'm not getting any money out of the deal, so I don't have any gain.
Yeah, I mean, it happens fairly often. But I think what happens even more often is somebody will sell a piece of property and say, well, I've got $185,000 cash coming out of this sale, so that's what I have to reinvest, right? That's my gain, and as long as I reinvest my gain, I should be good, right? I'm not getting any cash back, and the cash that you've got in a property, your equity you have in a property, has absolutely nothing to do with what your capital gain amount is and what your tax consequence may be. So understanding just some of the basics, what the basis is in the property, what their capital gains exposure is, and even when they know their capital gain exposure, have they talked to their CPA? Do they have losses elsewhere? Do they really need to do this transaction? Because I think we've talked about this before in the past. It's not uncommon. People will call in and we'll ask these questions of them, and then they'll go back to their CPA, and they might call back in and say, well, I don't have to do it this time around. Or I might be able to do an exchange and go down significantly in value and have some tax exposure on this transaction. But in my overall tax picture, I'm going to be fine. It's not going to create any issues for me.
So our position historically have been sort of, look at it, like you said, understand what your tax liability is, rationalize the investment. Don't just buy something to hide from tax, but understand what your liability is and then buy what you want to buy. But also to work with your tax professionals, and we're not talking April 14th. We're talking before. Talk to them before you ever list the thing for sale, so you understand what the liability is going to be there. But to Tom's point, before years in, you might have anything that's called boot in an exchange is going to be taxable to you. Boot's anything that's received that's not of like kind. Typically, people look at boot as cash received, but it could be a reduction in value. It could be maybe paying for something that you shouldn't have been paying for with the sales proceeds. It could be buying something that's not of like kind. A whole variety of things can happen there that could trigger boot. But to understand that years in, you need to be talking to your financial people too, maybe your Wall Street people, to look at, maybe I realized gain in this situation. I didn't fully satisfy everything for the 1031. I got what I wanted, but maybe to your point, I've got the ability to sell some stock and realize a loss that would offset the gain. And that's where it comes down to, back to what to do when a seller wants to do an exchange. We want to know, obviously, one, does the thing have tax exposure? We have to know who the taxpayer is, who owns that thing, what kind of property it is. And it's not what it is at the time of sale. 1031 applies to what something is at the time of sale. But how often do we work with somebody that has converted a primary residence into an investment, and if they were to sell it within 3 years of moving out, it still fits 121. So you're going to look at those things. We want to know the game. We want to know what they want to do in a perfect world. What do you want to do with this money? And I think the thing that really differentiates us from other companies is, we were taught from day one to facilitate exchanges. We're not just a passive intermediary accommodator holding money. So if you're looking for the cheap person to do a transaction, don't call us. I mean, you can go, deal with a half dozen different title company-owned companies that are just going to hold your money. But we want to know where you are today and where you want to be in 2, 5, or 10. It's an investment decision. I mean, Ron always stressed to us, it's not a tax or legal decision. It's purely an investment decision. So rationalize it, understand what's possible, ask the questions, but that's why our first call is going to be a half hour.
Yeah, it is, because these are questions that need to be asked, and hopefully, our clients usually have other professionals involved with the transaction. Some of these are questions that should be asked at the time. If they've not been asked before a listing, they should be asked at time of listing property. But yeah, planning is everything, and it's not uncommon, even with large transactions, that people will have had attorneys involved from day one, and we get into a transaction that's been contemplated and going on for a year's time, and a lot of things have not been addressed that should have been addressed, that will be affected when they're doing an exchange. We talk a lot about vesting of properties, and they might have a property transaction that is a partnership. We talk about this all the time with people. The vesting in properties is critically important in a 1031 exchange. And when partners want to go different ways, if that was something that was known a year, 2 years, 3 years in advance, and they had this property that they knew that they were going to dispose of in the future, then some steps should have been taken early on. Yeah, got to ask these questions.
Take advantage of the resources around you. So I think the big thing with what to do when a seller wants to do an exchange is obviously depends on who you are in the deal. But I'm going to tell you, don't close anything until you know what they're going to need. And I think we've had a variety of situations the last couple of years where maybe a deal blows up on the sales side and they still want to buy what they want to buy. And somebody say, well, just go buy it and you can do a reverse later, which is not the case. You got to have this. The exchange has got to be structured before any sale or purchase, period. So do not close a transaction without if you're working with us, your facilitator involved to get you where you want to go.
Yeah, and real quickly, I was talking to a client, future client, probably be in the next 6 or 8 months or so that they're selling, but they were really unaware of what they could go into on an acquisition side. And when I had explained the flexibility of types of properties that they could go into, their time frame changed a lot. They had a piece of property that they're just sick and tired of the headaches of managing tenants, and they're actually in a fairly friendly state as far as landlord-tenant laws are concerned, in favor of the landlord. It's just not something we're dealing with always. But anyway, they had initially expected they're going to be a couple years out before selling a piece of property. And when they learn the types of properties that they can go into, they're not hamstringed into certain types. They're gonna bump up their time frame and get their property on the market a lot sooner. And they were very happy about that, because again, they were just sick and tired of dealing with tenants over time, and that happens with a lot of people that have owned investment properties. Start out with rental properties, and if they don't get outside of those and get professional management, it's just a matter of time, I think, before they get pretty tired of it.
Oh, definitely. I think you and I have been there for a number of years. So let's go to the next question. What does a 1031 exchange do? Can you actually defer your capital gains tax? And we also hear people talk about tax-free exchanges. Do you care to make a comment on those terms and what actually happens in a transaction?
Yeah, and first of all, it is not a tax-free exchange, and we'll certainly make that very apparent to people when they start this transaction. It's not a tax-free exchange; it is a tax-deferred exchange. So, so you are deferring those taxes that would have been paid on a sale. You get to defer them until such time as you do sell a property in the future without doing an exchange transaction. And so a lot of people will say, well, aren't I just delaying the inevitable, and I'm going to have to pay these taxes anyway? Well, not necessarily, because there's a phrase that we use. It's swap until you drop, and that's exactly what you can do if you just continue to exchange over the years. And maybe you've got a piece of property that's not giving you what you need. Maybe in your earlier years when you're working, you've got a salary. You've got property that is not kicking out a lot of cash flow. It's maybe just an appreciating property. And so you get to retirement years. Now you need more cash flow. You'll exchange out of that into an income producing property that gives you more of what you need, or maybe you move to a different entity or a different area. Anyway, you're allowed to continue to change your type of investment as your investment needs change. But you don't have to pay those taxes until and such time as you do sell in the future.
So I made a comment earlier about Section 121 and the proposal that's certainly waking people up, or opening people's eyes with respect to elimination of gains on the sale of residence. Today, if somebody wants to do an exchange, let's say they do an exchange out of some investment property into a quote-unquote new investment property ultimately they move into, and let's say they live there a couple of years, can they then sell it and take advantage of today's 250 or 500? Or better yet, if this thing were to pass, get rid of it entirely if the gains go entirely away?
No, that doesn't work. And real quickly before we jump onto that, I was going to back to the swap
till you drop
comment. Because what happens with that in the future, the way everything's set up right now, if you do that and you end up leaving those properties to your heirs, all those gains that you had up until that date that you pass basically go away, because your heirs inherit the new property and they get a new stepped up tax basis in the property. So if they've got a new basis, they could theoretically just turn around and sell the property at that amount and not have any capital gains exposure. If they hold it, then of course you're going to have gains as the property appreciates from that point forward.
It's really important for people to understand when they contemplate a sale what the tax consequence is going to be. And sometimes the best thing you do is pay the tax, but you need to understand what that liability is going to be so you can make the intelligent decision going forward. And I think that's one of the big things that we spend a lot of time really trying to ensure our clients are doing what they need to do and not doing what they don't need to do.
So now back to your question.
Yeah. What was that question again?
Yes.
Back to the conversion of a property and ultimate sale, utilizing 121 or whatever it becomes in the future.
Yeah. So when Section 121 first came about, we would have people that would do an exchange transaction into a new property. They might rent it out for a couple of years, convert it to a residence, which that in and of itself is not a taxable event, that conversion from investment to primary residence. But then they'd hold it and live in it for 2 years, sell it, and take that that Section 121 exemption. IRS caught on that pretty quickly, and so that went away. What was the year on that?
It was around 2000 somewhere, early 2000s.
Anyway, what happens with those now is that the IRS, it's fairly complicated, but you can start to take some of your exemption after a couple different things happen. So if you buy or exchange into a new property, and if you hold that property for at least 5 years, and you have lived in it for at least 2 of those 5 years, then you can start to take some of the exemption of that Section 121, because you will start into what the IRS calls qualified use. So the time that you live in the property is going to be qualified. All the time that the property has been treated as investment property, and it doesn't just go for the new property, but goes back, is all going to be non-qualified use, and they're going to do a proration for that 121 amount of the qualified versus non-qualified use. So, and I had this conversation again with somebody yesterday that was talking about doing this, and so
it was a great new idea, right?
Yeah.
No,
it comes up all the time. This is another one of those questions that pops up all the time, because people know what the exemption amount is for the personal residence and think, well, if I do this, I can just jump in and do that, take advantage of that exemption after living there for a couple of years. And so what I will always tell them is it's a great way to get into a piece of property that you want to live in. If you do an exchange into a property that you eventually want to move into, fantastic, and rent out for a little while, move into it again. That is going to be a non-taxed event, that conversion. But don't plan on it being a short term. If it's a property that you plan on living out your years in, or living there for the foreseeable future, then maybe it makes sense. But don't expect to be able to exchange into a piece of property, treat it as a rental for a few years, move into it, and then be able to take that larger 121 exemption, or as you mentioned, have a tax-free sale in the future.
So what you're talking about is the Housing Assistance Tax Act of 2008, and you made a comment about qualified and non-qualified use periods. So the non-qualified use, back to what Tom had just said, the non-qualified use, this law became effective April of 2009. So any time that you had properties between April of 2009 and the date of conversion would be non-qualified use. The qualified use is the time that you're living in it. So as Tom said, if you're doing this to get rid of gain and you think you're going to be there for a short period of time and do it, it doesn't work. It was a great idea for a couple of years back in the late 90s. But that's gone. It's typically something, if you're doing it to buy your forever home, do it. But if you're doing this thing in an exercise to get rid of tax, don't bother, because it's probably not going to take care of you.
Yeah, you'll get very little relief for quite some time. And if it was a rental property that maybe you only had for a couple of years and your gains were not that large in it, then maybe after owning it for 5, 6, 7 years and having some, a good portion of that being your residence, maybe you will benefit. But again, not a good idea to think you're going to get much relief going forward into that.
So another part of the conversation we have with somebody that's telling us, hey, I'm going to sell this thing. I want to go out and buy a property, my forever home. I'm going to do this thing, or whatever they want to do with it. We back to Tom's answer to the first question was, well, what's the tax consequence, right? Because you've got to make sure that what you're doing actually makes fiscal sense. So tax deferral isn't always the right thing. And an example would be, let's say you're giving up a property, you go out, you buy a new property you ultimately want to move into. One, I've got to say there's no black and white required hold in the code, so it's going to be up to you and your tax people how long. But let's just say it's a year, or maybe it's 2 years. So, maybe you're in a place where this home would, you're buying a property ultimately you want to move into, but you can't move into it for, let's say, best case, 12 months, possibly 24 months. And maybe you're living someplace else now, and that's costing you $3,000 a month. Well, I mean, that's eating up a chunk of capital, somewhere it could be, 30, 40, 50, 60, 70, $80,000. So does the exchange make sense if your gain is only 60,000 or taxable or something? Obviously no. So that's why that first call, we want to make sure that you're actually getting where you want, and tax deferral isn't always the right thing to do. Making sure you're getting where you want, living comfortable, being happy. I mean, I think as we get older, time is critical, health is critical, and to do things, get you where you want to be and be happy about it. And sometimes paying some taxes is the right thing to do.
Yeah. Yeah. We've had transactions with capital gains that are very small, and people don't want to pay dime one. They might have a $5,000 tax exposure on a sale transaction, and they might be giving up $1,500 or so in fees to us, but when the transaction's said and done, or maybe it's $1,000 depending on how big the deal is. But at any rate, they're adamant they don't want to spend any taxes or any money on taxes, and then you've got maybe that was right for them, but you've got the other investor that doesn't want to deal with any property anymore at all, and it makes sense for them to pay a pretty hefty tax bill. So yeah, it's just what the individual wants and needs out of their transaction.
We're so good. I didn't even realize. It's like, okay, we just took the second question and actually we're answering the third question right now. That's how on top of it we are. Is skipping the 1031 exchange and selling your property the right move? Look at that.
Sometimes.
It depends, right?
Yeah.
Depends what your definition of is.
Yeah. And I don't know what sort of answer you're going to get if you just ask the computer that.
AI is going to give you a good answer to that, I'm sure. What is it going to ask you a follow-up question and try to sort of pin you down on that?
There will probably be a bunch of follow-up questions, I'm sure. Yeah.
So when you're looking at that, is skipping the 1031 exchange and selling your property the right move? I think Tom and I, through the years, have answered questions on, well, hey, I'm going to have to pay the tax at some point anyway. Why not pay it today? We've answered that question over and over and over again through the years. And I think the first you talked about earlier, swap until you drop. So one way, you're not always going to be on the hook for it. But I like, especially since we sell retirement accounts too, I mean, I got to tell you, I'm not and you know this about me, I'm not the biggest fan of retirement accounts, period. But, they're there and they can be a great tool for people. But when we look at that question, sometimes people say, well, gee, why am I going to do the exchange? I'm going to have to pay the tax at some point anyway. So, okay, do you have an IRA or 401k plan? Well, yeah. Okay, so why? You're going to have to pay the tax at some point anyway. And the tax consequence on that IRA or 401k is way worse than the long term. I mean, you're looking at normal income tax on distributions of any of that stuff. And if you're under 59.5, not only are you looking at normal income tax, but a 10% penalty on it if you got money in those things. Where here, worst case, you selling a property held for resale or didn't hold long enough for long-term gains. Best case, you sell and pay long-term capital gains tax consequences, or actually the absolute best case is do the exchange and until at some point it either makes tax sense or you pass away, or so you're looking at
during those years that you hold it, we all know real estate's got a lot of other tax benefits, and just the depreciation factor can help people's income taxes over the years, and so is skipping it the right thing to do?
It depends.
It depends. And there will be people who will call up and think they've got to do an exchange, and after talking with us and then talking again with their CPAs, they decide they're not going to do it. Or what we see, I think that we see this more and more over the years, a lot more so than we did when we first started doing this. I think we see a lot more partial 1031s now than we ever have in the past, where people, they're not too concerned with pulling some cash out or going down in value and having some tax exposure. They just don't want to pay taxes on the entire capital gain. And sometimes they don't know that is even a possibility when they first call in. That happens all the time with people, and they might call up initially and think, well, I want to pull out, and I've got a big sale. I want to pull out 150,000 cash, and I don't mind paying taxes on it this year. I've got some loss, whatever. And that might be the initial thought when they go into it. And as they get closer to a sale transaction, things change. And, we had somebody the other day that was going to pull out about that much, and they changed it. Now they're only pulling out 25 at closing. It has to go directly to them. If it comes to us, we've talked about this in the past, if it comes to us, then they can't get that money.
So that's what I was just going to say. So we're wrapping up on our time, but so if they want to pull money out, when can they get it out? And we've addressed it on other videos with 1031 G6, but why don't I just hit that real quick?
So
after I interrupted you.
But just to clarify that, it's more and more common that we see partial 1031 exchange transactions, and there's some tax exposure. So as far as when they can take the money out, the IRS is very clear about this. 1031 G6 spells this out. We've got extra pages in our paperwork that goes out to people to sign, because people will call us and say, hey, I want to pull this money out, and we don't like to tell them that, well, you can't do it until this happens or this happens, but that is the case. It's not our policies and procedures. It's the IRS code section that spells this out. G6 says that as soon as money comes to us, then the only time that we can really release funds to the client would be after the 45-day time period passes, if they have not identified anything, or after, if we've passed the 45 days and they have identified properties, then after they have acquired all of those properties that they are entitled to acquire under the ID form, then any remaining cash can be released to them. So if people do want to pull money out and they know how much they want to pull out, in this case, this gentleman had 25,000 they wanted to pull out, we've got a section on our assignment agreement that removes that from the exchange. So it's listed as retained taxable proceeds. It's spelled out ahead of time. So when escrow closes, client receives a check for that portion of the money. The rest of the money comes into the exchange account, and now that money that we receive is subject to 1031 G6. And so somebody calls us on day 30 and says, I'm not going to be able to identify anything. Just send money to us. So, well, if that's the case, we have to wait until 45 days passes. If they've not identified anything to us by day 45, then we'll send out our distribution form. They'll fill it out, let us know how they want to receive it. They can receive funds after day 45, day 46 on. If they've identified properties, let's say they've identified 3 properties and they've gone out and acquired 2 of those properties, and there's still some cash in the account, because that third property has been identified and it's on the form, we can't release that money to them unless they have also stated, and our forms have a spot on them where if they're identifying, say again, 3 properties, they can state on the form that they are entitled to acquire no more than, and they'll list the number. So if they want to acquire 2 properties, if it identified 3, they can state on there that they're entitled to acquire no more than 2 of those properties. So after that second property has been acquired, we cannot buy any other properties for them. Therefore, exchange is really final at that point in time, and any cash that's remaining in the account, even though we may have some time in the exchange, they don't have any other properties that can be acquired under the ID form, so remaining cash can be released to them at that point.
So Tom, that sounds like a pain in the neck. I mean, it sounds like working with Equity Advantage, following 1031 G6 is a real problem. My accommodator is just going to give me the money when I want it. Why shouldn't I keep working with them?
Steer clear of that.
Steer clear of them. Why?
Steer clear, because if that is the case, and if we were to do that for anybody, any one client, then our policies and procedures they're violating G6, and it will affect every one of our clients. And so what happens is all of those clients, in a nutshell, they all have constructive receipt of funds, meaning they can ask for those funds at any point in time. And if somebody has constructive receipt, they don't have an exchange.
Yeah. That's a huge, huge issue to be aware of. And you might be working with somebody that's just going to give you the money as you want it, and your attitude is, hey, I don't care, I'm going to pay the tax anyway. But anybody else working with that company is vulnerable to that situation. So, when you're paying a company to turn your sale and purchase into an exchange, that's what you're really doing with a three-way transaction these days. We're paid a fee to take your sale and purchase and turn it into an exchange. We do that by assigning ourselves in as a part of the transaction. You give us something, we sell it. You tell us what to buy, we buy it, we give it back to you. This code's over 100 years old at this point, and we have some updates on rules every so often. We really haven't had much after, maybe Rev Proc 2000-37 on reverses, but every once in a while they'll come up with something there. But this 1031 G6 issue is one that's really important for people to understand. You want to be working with people that do this and have been doing it for a living and have been through good times and bad times and have, the scars and stories to tell you about that stuff. So when you're going through these transactions, ask a bunch of questions. Don't just ask what the cost is for a transaction. It's really important that you go through the transaction. Working with us, we're going to, we want to know what the liability is, tax liability is, and justify the exchange, rationalize it for you. And I think that's one of those things that really you and I have taken pride in through the years. It's just the integrity of making sure it's right for people, not just doing a deal to get a fee for that transaction.
Yeah, and that they understand the process, they understand the parameters of the transaction and what's possible, what's not possible. So they need to know how they're benefiting and why.
So with that said, if you got questions on anything we talked about today, or you've got questions on anything else in the 1031 or self-directed retirement spaces, we're happy to address those things. If you got questions on other issues, on investment real estate, we're happy to address those. So today, it's always fun to have you in here with me, bro, and been great to work with you all these years. And I think this is fun to have these little conversations.
Good times.
Yeah.
Good times.
So David and Tom Moore, the Exchange Bros, 1031exchange.com, Equity Advantage, and IRA Advantage. Thank you.
Thank you.